Do you grow value the right way? Are you out there making organizational improvements, cutting costs? It really does now come down to what is the team at your private equity strategy? How good are you really?
We're also seeing situations where software and AI, a lot of companies in the US have budgets that pay for software and want that innovation in their enterprises. Whereas in some other parts of the world, folks don't want to pay for software, but they're willing to pay for the benefit, so software, but they want the work.
We find it quite interesting that as interest rates have gone up, if you look at different segments of the market, if you look at real estate, the cap rates haven't risen to the same extent as interest rates, and they should. Bankruptcies are at the same place they were in 2008.
Instead of growth for growth's sake, it's efficient growth now. Really looking at the underlying portfolio companies, doing real due diligence before you're cutting checks. The LPs are getting a little more savvy on that. They're also getting a little bit more power back, I would say.
So I serve as chair of the board of CFA Society New York. We're the largest association of finance professionals in New York. We have around 11,000 members. And I also founded the Asset Owner Series. So since 2015, we've hosted over $40 trillion of fiduciary asset owners who have spoken at our events, around 70 events that have taken place around the world. So we're really proud of that. Fiduciary asset owners from sovereign wealth funds, pension funds, insurance company general accounts, endowments, foundations, and the like. I also serve in my day job. I work at Rescura, and we're an investment consultant. We advise on about $200 billion worth of pension fund assets, and we focus on manager selection in addition to asset allocation for our clients. And then finally, I just want to thank my dear friend Deepika Patel for connecting me with the Sovereign Wealth Fund Institute. This is really a great program, and I'm really privileged to be moderating the opening panel. We'll start with Brian.
Hi, my name is Brian Hedrick. I'm the portfolio manager for the pension fund of the Dallas-Fort Worth International Airport. So I think I'm one of the few public funds here today, if there's any others. We're about $1 billion, and we allocate 12.5% to private equity. And I've been allocating to private equity for over 15 years now.
Okay. I'm Ben Pagefort. I run strategy for SimCorp, which is a Danish financial technology company. We provide accounting and investment book of record services for asset owners and asset managers, primarily multi-asset class investors on the buy side. I have spent the last 10 years or so of my career working primarily with asset owners and allocators, sovereign wealth, pension, family office, around handling their total portfolios. So how do you get your arms around public and private markets, especially as we're starting to get more into direct investing and private placements and all of the different investment approaches that folks can take.
Hi all, this is Kutral Veerabhadran, and I run the venture capital arm with the Nunman Group, and we are based in Dallas, and we primarily invest in early stage tech and tech-enabled companies, and within the tech companies we're completely agnostic. And the Nunman Group, as most of you would have heard last night from GK, our CEO, we have different verticals. So venture capital is one of them. We also have the realty, we have the ESG, which we're going to be launching, and several exciting things are going on in Nunman. And Lakshmi specifically asked me to talk about this during my introduction. So before I got in the world of finance, in the world of investments with Nunman right now, previously in my past life, I used to be a professional athlete. I used to be a marathon swimmer, and one of the best things is I got on the Guinness Book of World Records. My record still stands for swimming across the English Channel when I was 12. So yeah, that was a specific instruction from Lakshmi to also given that dimension from where I come from. Thank you.
That's awesome. It's going to be hard to top that. Hi everyone, good morning. My name is Anand Chandrasekharan. I work at General Catalyst. We are a multi-stage, sector-agnostic venture capital firm. Originally got started in Boston and I'm based in San Francisco area and part of the West Coast team. But we invest pretty globally across the U.S., Europe, Israel, India, and other parts of the world as well. We're pretty, stage and sector agnostic and try to partner with founders really early in the cycle, and then sort of want to stay partnered with them over a long period of time. Some of the notable companies we're investors in include Stripe, Airbnb, Canva, Grammarly, Samsara, and many others. Thank you for having me.
Great. Hi, I'm Candice Beaumont, Chief Investment Officer of L Investments and Chairman of Salsano Group. I'm a former professional tennis player, and Sandro Salsano is a number 6 ranked billionaire in Central America. Sandro and I are both 2014 Young Global Leaders of the World Economic Forum, and we have a pretty diverse asset allocation across private equity. We're an LP in a few funds, but Sandro has been named the Warren Buffett of Central America. He's been on the cover of Forbes many times. And so we really look to make private equity investments at reasonable multiples. And I'm also involved with a family foundation. I sit on the board of a number of charities, as well as a number of our holding companies. And Sandro is country chair for Global Dignity, which is Crown Prince Haakon of Norway's charity that helps children respect each other regardless of difference in background. And I'm on their International Council of Advisors with Sir Richard Branson and a number of others. And Sandro funds all of their operations in Panama. And Crown Prince Haakon of Norway is also a young global leader of the World Economic Forum, so part of the same community. And the family really tries to have philanthropic impact as well as make investments that are for the greater good. And Sandro just became board of trustees of University of San Diego, where he went to school, and he's giving, I think, hundreds of scholarships to give back, and is also somewhat helping run their endowment as well. So that's a quick summary on us.
Excellent. Thank you so much, Candice. So Brian, to kick us off, as the portfolio manager for DFW Airport's pension funds, what are some long-term trends you're seeing in the PE space from your asset allocator viewpoint?
Yeah, you can say, throw out the need for data and analytics in every industry, the continued growth in dry powder in private equity. But the biggest change we're going to see over the next easily 5 to 10 years is how much more expensive the financing is going to be. Your dividend recapitalization just got a whole lot more expensive. And it will behoove those of us that invest in private equity, whether it's buyout, growth, venture, et cetera, as we do our due diligence on management teams, do you grow value the right way, right? Are you out there making organizational improvements, cutting costs, et cetera? The days of simple financial engineering done, that's gone, that's easily over. So really, it really does now come down to what is the team at your private equity strategy? How good are you really? So that's far and away the biggest change, and that's going to continue for a while.
Excellent. Thank you so much, Brian. So moving to Kutral. So let's transition the discussion a little bit towards the VC end of the PE spectrum. So given current macro conditions, what do you look for in companies that come to you for VC investments?
Sure. So, of course, all of us will be very, very familiar with what's going on in the macro, right? At least for the last 6 months, if not a year. Things have drastically changed since 2021, right? And when it comes specifically to venture capital, we at the Nunban Ventures, as I told you, we invest in relatively early stage tech companies. So with the definition, our exit is, we are looking at anywhere between like 5 to 8 years, kind of an exit horizon. So these blips in macro will not really impact, because that is not the lens which we actually use to evaluate companies. But one of the critical things which we have started doing more rigorously at Ventures when we look at companies is to kind of like pay attention to the line of profitability for these companies. I mean, do they have a line of sight for profitability, right? Before, VC used to be all of the growth. It is still all of the growth because it's high risk, high reward. So what I mean by growth is, like, there might be companies who might kind of postpone the profitability or black line EBITDA for getting scale in their revenues or any kind of scale they're looking at. But at this particular point, we would like to see some kind of clarity and timeline by which the company can comfortably get across the line where they can kind of sustain themselves with the operational cash flow, right? So that is one thing which we've started paying a lot of attention to. And of course, everything else kind of translates and it kind of migrates from the same thing. When we talk about unit economics or we talk about like the sufficiency of capital which can get the company to the finish line, that's become very critical because all said and done, I mean, if in case we kind of like go through a slowdown, which most of us feel which might be hitting us sometime next year, we need to make sure this company can survive the next 2 or 3 years in a dried up environment for capital markets and dried up environment for like capital. So that is something which we really focus on, and that's what I think we will be continuing to focus on as well from the venture capital point of view.
Excellent. Thank you so much. Anand, so let's move to a more global perspective. So how do you handle geographies like India, Europe, and Latin America differently than the US?
Yeah, so when we have a thesis or a focus area that we are very excited about, sometimes, we've seen the movie before in the US, and when we kind of go into a new market, sometimes that same cycle starts to happen in that part of the world separately, like at a different point in time. And in a way, having seen that exact same thing happen in the States allows you to have a right to play, right to win with that company, because you actually can have a reason why you're going to be a great investor on the cap table. But we're also seeing situations where, for example, software and AI, a lot of companies in the US have budgets that pay for software and want that innovation in their enterprises, whereas in some other parts of the world, folks don't want to pay for software, but they're willing to pay for the benefit. So I don't want the software, but I want the work and the benefit of it. And so there are probably commerce business models where you actually sell the software for free and actually take a cut out of, maybe impact on the business, like, better raw materials or, higher quality finished goods and so on. And so it's largely the same kind of, technically the architecture looks very similar, but sometimes the business models are very different in some parts of the world. And, we sometimes within the firm talk about having an open mind around, seeing those as ultimately really successful, important companies versus sort of saying it has to be certain, we have to prescribe it a certain way. And also culturally, sometimes it's different to engage with founders in those parts of the world, where, for example, even simple things like time zones, we're all used to, them sort of joining during sort of a graveyard shift for them. And we also sometimes take simple things like that into account, where are we able to join a board meeting when it's maybe 9 a.m. In their part of the world once in a while.
I know the feeling. So Candace, over to you and over to interest rates. So are you concerned that return thresholds and multiples have not increased with interest rates over the past 15 months or so? And do you think this would reset soon?
We find it quite interesting that as interest rates have gone up, if you look at different segments of the market, if you look at real estate, the cap rates haven't risen to the same extent as interest rates, and they should. Mm-hmm. And, we do think that the high interest rate, I'm seeing it across the board. Someone sent me a chart yesterday that showed bankruptcies are at the same place they were at 2008. And we're starting to see it everywhere. We're getting calls from families that own buildings in New York, and they bought buildings, marquee buildings, for a 3 cap. They had variable debt. Their debt is now, multiples of that, and they're losing money every month. And it's a beginning of a bit of a distress cycle. They're not desperate. They're trying to have a quiet fire sale so that they can get some liquidity. And then on the corporate side, I was supposed to do a friend a favor and be on the board of a company, emerging company, had, 15, 20 million of EBITDA in the plant-based food sector. And it was going public, and then I was told recently that they're having financial problems and they can't pay the auditors. I was like, what do you mean? They had a lot of EBITDA. And they're like, yeah, but they had a lot of debt, and the interest rate went up on all their debt to 8%. And now all the EBITDA they had is paying all that excess debt, and they're distressed. I was like, this is a great company and a great business. So just from like the companies we're investing in and the things we're seeing, we're starting to see like, you know, this high interest rate environment, if it goes any higher, the wheels are starting to come off the bus in many different sectors. In technology, we've seen mass firing. In real estate, you're seeing owners of buildings, you know, can't make their debt covenants. And then some of the families we know that aren't as savvy as we are, they've been telling me that they're buying buildings for a 4 cap. I'm like, well, can you explain to me how that works? Because the cost of debt is higher than your cash flow. And they're like, oh, but we've got these really great projections. And, you know, if you look at, say, multifamily, rents are going up 20% a year. I was like, but don't you think they've stabilized now? They're like, no, when they go up, we'll be able to cover our debt. So people that aren't as sophisticated are doing really stupid things. And so there's only so long they can play that cycle and they can have negative cash flow for a while. And then after a while, you've got a lot of people with negative cash flow. And I think it'll reset and I think it'll catch up. And you're starting to see pockets, like we're looking at some deals now. We're looking at a hotel that was for sale in Miami for like a 16 cap. So you're starting to see isolated incidences, say in real estate, of higher cap rates. And then companies also, I think because we look at doing private equity and also buying companies, and we're seeing, you know, kind of the, you know, companies that would be at 12 or 10 times EBITDA now are a 4. So yes, I think we're starting to see it reset, but it's not across the board. A lot of people still have unrealistic expectations, and across the board, you know, the multiples haven't corrected the way they should with a high interest rate environment. So I think we live in interesting times, and we'll see how this all plays out.
If I can jump in on that, if you're younger than 35, you don't know what it's like to pay more than 5% on a mortgage. It's ridiculous. I mean, you don't know what a 5% 10-year yield actually means. And so I think you can chalk a lot of that up to exactly that point.
Oh, exactly. Thank you so much. Ben, so we're going to continue the interest rate discussion and want to get a sense for your take. Are you seeing a change in how your clients are investing specifically into private markets in light of this new interest rate environment?
Yeah, I think interest rates are a big part of it, but I think it goes well beyond that too. Something, you know, a trend in all of these is instead of growth, you know, for growth's sake, it's efficient growth now. You know, really looking at the underlying portfolio companies, doing real due diligence before you're cutting checks. The LPs are getting a little more savvy on that. They're also getting a little bit more power back, I would say. So having more say in their structures with GPs, having, you know, instead of, you know, getting a re-up into a fund that comes on a Monday and they expect you to pay up by Friday, no questions asked. They're able to ask questions and push back in a way they didn't. We're also seeing a lot of the larger LPs getting away from the pure GP fund model and doing a lot more co-invest and a lot more direct. Bringing the, you know, folks that actually have GP knowledge and investor capabilities in-house and doing it themselves, as opposed to going through a fund or even more, you know, inefficient a fund of funds structure that, you know, historically was fine for them. They got the returns they wanted or something close to it, and it was hands off. They're getting a lot more hands on. Partially that's because of what they've seen over the last few years. Partially it's a sophistication of those LP investors.
Excellent. Thank you so much, Ben. Brian, back to you. So how does a public pension fund look at private equity with respect specifically to lack of liquidity relative to how a family office might look at it?
Yeah, that's probably and that's an example of one of the biggest differentiators between what a public pension has to do and whether you're, you know, we're $1 billion, but you can also take someone like a Texas Teachers, which is $280 billion, right? Our structure is much more rigid, right? We have an asset allocation model, we have a range for private equity, and you have to stick to that. So if a great idea comes along but you don't have the juice for it, you have to pass on it. If it doesn't fit your pacing model or if it doesn't fit your current exposure, you know, ideal, you can't necessarily jump on it. So with respect to liquidity, we have to plan it out. I mean, most public plans have to take a 50-year horizon, right? We have to. That's why a public pension exists. So we have to plan out our cash flows incredibly granularly to say, okay, how much are we expecting to come in distributions? How much are we expecting to go out in distributions, or to go out in cap calls? So I don't know. We just have to be more structured. Is really the name of the game. You can't do 20% in venture. You just can't. That'd be great, but we just can't take that kind of risk, the kind of liquidity risk that comes with that structure. So for public plans, generally you see a much larger allocation to buyouts. So buyouts are going to be 60%, let's say. You're going to have 20% in growth. You'll probably have 10% in venture and 10% in co-investments and secondaries. Although I will agree that the secondary and the co-investment is becoming much larger. The larger plans, especially at states, teacher pensions, they're bringing in those former GPs to say, help us make those kind of investments. So, but because they have the size to do it, they can. So you're absolutely seeing that. Co-investment has an advantage in management fees and liquidity. Horizons generally tend to be shorter. So you're definitely seeing scale bring benefits, but for most of us who are in that billion to, let's say, 5 billion, 10 billion range, you have to stay within your lane. We generally all have boards that we have to report to and get approval from, and the level of sophistication for those boards definitely matters. Some will have professional investors on them, some won't. And so you have to gauge the comfort level of that board as well with different strategies in private equity. But for the most part, it's going to be much more vanilla, I think, than a family office is going to be, just out of necessity.
Makes sense. So Kutral, over to you. So what is your view on the various levers that the PE industry, and specifically VC, is going to have over the next 2 to 3 years, given everything that we've discussed so far?
Yeah, sure. See, at the Nunban, in fact, we have been ideating, or in fact, we have been looking at starting an active private equity practice for a while, right? And this is kind of like my take and even Nunban's take in that particular aspect, especially when it comes to private equity. You've heard all the panel members already talk about most of these pointers. So the headline item is, of course, the cost of capital, right? The current interest rate environment. It'll have a direct impact on the world of private equity, because guess what? All of us know private equity pretty much operates on the concept of leverage, right? Mm-hmm. But what we feel is the next 2 to 3 years, or an even more narrow band, next 18 to 24 months, is an ideal time to be, especially in the mid-market private equity, if you have the deployable capital. Because as even Candice was referring to earlier, the valuations have come down. There might be really good assets out in the market to be acquired, provided you have the deployable capital. And see, the private equity horizon is at least 5 to 6 years, right? Because that's the play. You go acquire a company, you turn it around, and even if your fund is like a 6 or 7 year life cycle, you have the 4 to 6 year kind of a window with you. So looking at the macro, when you can actually tap into golden assets, or very, very solid assets at reduced valuations to just what they were a couple of years ago, it'll be a very interesting proposition for funds or with family offices or with individuals with deployable capital, right? And even going by statistics. So this is one of the things which I came across very recently, right? So this year in 2023, the mid-market private equity deal value comprises over 70% of the entire PE buyouts. Just in 2021, it was just 40%. So you can see the entire transition just in a year and a half. And there are multiple kind of like forces behind it. That's what I kind of like, we're looking at. So one of the things is not just the interest rate environment, which of course is a direct kind of an impact to any kind of private equity, but also since the valuations have come down, the secondaries within the private equity market, as in one PE shop selling his asset to a different PE shop, is not really happening because they don't want to sell it at a depressed valuation, not in this environment. So a lot of sale is being kind of held back. So the kind of companies which is actually coming to the market are these non-backed, founder-led businesses, which are very legit businesses if you look at the mid-market private equity. And those are the businesses which can readily be lapped up And if you have a pretty good horizon, and if you have the expertise in that particular industry, I'm sure like it will be a very good kind of a risk reward in the next 5 to 6 years. So that is the kind of the view which we are taking from the private equity scheme of things. And just to briefly touch upon the venture capital angle, of course, we're a venture capital fund. We have been investing in venture capital. As I kind of touched upon even in my previous response, the macro is not the only lens in which we look at the venture capital investments just because of the nature of the game, right? And we all know it's high risk, high reward, but we also have the flexibility of a longer time horizon. These macro environments is going to change in 2, 3, if not 4 years at best. The only thing we will pay attention to, can the companies in which we invest in survive these 2 to 3 years of winter, if at all there's a winter. Outside of that, every other principle remains the same. And yesterday, I'm sure all of us heard to Mr. Jeff Hoffman, right? The entrepreneurs, as long as they go after the problem, own the problem, eventually they will be winners. So when we look at companies, we look whether those companies actually address a problem, not just an incremental benefit to what is already there, but whether that can fundamentally change or bring in completely new innovation. So that automatically says in long term, most likely they'll be winners. So that's Nanban's view, and that's how we kind of think about both private equity and venture capital. Thank you.
Excellent. Thank you so much. So, Anand, switching gears a little bit, moving from the macro to the micro, maybe if you could give a little bit of, share a little bit of your insights on your unique creation fund.
Yeah, I think it's a good segue from what Kutral was just talking about. So we, a number of the partners at General Catalyst are former operators and company builders. And one of the things that the firm started doing, even in the very early days, probably a little bit more informally, was actually starting a company from scratch or buying and transforming with a GC partner being actively involved in each of those. And in the last fund cycle, Fund 11, we decided to formalize this and call this the Creation Fund. So two types of companies that we kind of work on in the Creation Fund. One is where there is a kind of a technology opportunity. You know, AI is a great example, which can transform industries. We actually create companies from scratch, and oftentimes, you know, a partner at General Catalyst is involved with that business for the first 6 months or so, and we bring the team in after that. And that's usually driven by the thesis that we can, you know, we tried to find a company to invest in. We couldn't really find that company, but there's a need for that company to exist, and so let's go create it. And then the other is a little bit of what, Kutral, you were talking about, which is we can actually buy and transform, where there are existing assets that maybe don't have a growth mindset because of the folks on the cap table. They are not seeing this company as a growth asset. And maybe they need a different or some additional management team members. And sometimes, you know, we are able to bring that directly as well as with LPs, like we just talked about co-investments, for example. Sometimes they like to invest in an important company in that sector where they're actually value-added investors, not just an LP. And so we call that VBO, which is the concept of LBO, but with a venture mindset. And so you actually buy the asset, and you're not looking to make it more efficient. You're actually looking to invest in the growth of the asset. And so we sort of look at assets, companies, for the 0 to 1 creation, we call a hatch within the creation fund. And then the slightly further along companies that we can acquire and transform, we call that VBOs. So it's a pretty unique asset, and particularly in sort of today's day and age, we see you know, a lot of companies that have been around for 5 or 10 years, but really can still be growth assets. And you know, if you take that long-term horizon, you can actually invest in growth for the next 5 to 10 years as well, even though the company is not, you know, purely getting started today. So we've been doing this. It's a pretty unique aspect of the fund, and we really enjoy it. And actually, it also gives us some empathy from a founder experience, because if you are, you know, in a pseudo founding experience and you're building a business, you're able to see what's going on firsthand that some of your founders are going through as well. And so when it comes up in board discussions, you're able to empathize with, you know, whether it's interest rates, whether it's hiring. Sometimes you also see that a little bit early, then you start hearing it as an investor when you're doing so we sometimes use the creation founders to inform us about broadly, where should we be paying attention from a company growth experience as well. But this is something we intend to continue in future fund cycles as well.
Excellent, thank you so much. So Candace, moving from the micro back to the macro. So what are some sectors that you're most focused on now? I know that you were active in several SPACs, but with equity markets where they are now, what do you think of SPACs in addition to what sectors are you focusing on?
So obviously, I think, about a year and a half ago when equity capital markets were on fire, I remember talking to my lawyer, and it's like everyone was coming out with a SPAC. Barry Sternlicht was coming out with a SPAC. Every private equity guy was coming out with a SPAC. Every billionaire was coming out with a SPAC. It was quite humorous. And my lawyer said, oh, the pipe market is so robust. Every $100 million pipe has $1 billion of capital. And I was like, that's not going to last, And he's like, well, it's 10 times oversubscribed. Even if it doesn't last, it's going to be 2 times oversubscribed. I was like, no. You need to lock in forward purchase agreements and secure your capital now, where capital is robust and everyone's falling over begging to be in your deal, because this is not going to last. And my lawyer said, oh, no, you're wrong. It's a new paradigm. Of course, my lawyer was wrong and I was right, and hindsight is 20/20. And obviously now equity capital markets across the board are weak. It's hard for companies to go public in a regular IPO. The window for a SPAC IPO is still open. So I think capital markets, what's interesting, we still like the asset class. And we think for companies looking to access equity capital markets, there's some advantages in terms of you can set the valuation with the management team. So we've been looking at some publicly traded companies on other exchanges, and in the TSX, in Europe, in Hong Kong, companies trade at a discount to what they do in the United States. So there's a real arbitrage between where valuations are trading. And so there's a real value-added proposition for companies to, even if they're public elsewhere, to go public in the United States. So I'm on the board of, I think, about 3 or 4 SPACs, and advisor to a few others. And we were invested in the asset class. We invested in the risk capital of a number of sponsors. And we're actually coming out with our own. Sandra was coming out with a Latin American SPAC. And I was doing a healthcare technology SPAC. And that was when capital markets collapsed. And then we said, okay, we don't have the risk profile to continue in a weak equity capital market environment, and we're already allocated to the asset class. But long term, we do like the asset class. We think eventually it will come back, and it's obviously something that's correlated to equity capital markets. And we still think it's a niche for companies that are going public. And obviously, we think some of the changes have been welcome, because when markets were frothy, you were getting flying taxis that had no revenue and no chance of getting revenue, and they were going public at speculative numbers. And obviously that's not good for anyone. That's not good for capital markets. That's not good for investors. So we think cleaning up that environment, and now the companies that are going public, they predominantly have EBITDA, they're good companies, they're high growth companies. So we think that niche will continue. It's obviously a tougher environment. We're not coming out with our own SPACs right now. But we have a lot of deal flow. So, for the SPACs we're invested in, we've been, helping them to access some of the deal flow that we see, because we see so much deal flow as a family office, both on our own, and then we get co-investment opportunities from a lot of the private equity funds we're LPs in. And in terms of sectors we like, we've been looking at healthcare. Been looking at co-investing with another family that's actually here today. The Cohen family office on mental behavioral health facilities. So we like the healthcare sector. We like segments of real estate. Sandra is building the largest free trade zone in Central and Latin America in Panama, where the CCC, the Chinese, are co-invested with us. And the DMCC Dubai has also become a strategic partner. We announced an MOU with them. And of course, Dubai owns a lot of ports, so and they have free trade zones in the Gulf, so they can be a very strategic, value-added partner for us as we build the largest free trade zone in Central and Latin America. So So yeah, we're like kind of insanely busy across a lot of sectors. So I think that's what's interesting about working for a family office in a billionaire family, is you literally look at everything, see everything. Like, it's overstimulating. You're seeing too many things. I get 600 emails a day. I tell people, if I don't write back to you, send it again. Assume I didn't see it because there's too many emails coming in my box. But I think that intel and that information and that data set, if you can process it all, you can find some interesting opportunities in that subset.
Thank you so much, Candace. So Ben, shifting gears into a single sector, technology, how do you see technology innovations affecting private markets and how GPs work with their LPs?
Yes, I think it's in multiple ways. Obviously, technology is a big investment area for private capital, and that's continuing. It's not going away anytime soon. It's growing and growing. Obviously the AI stuff of today is the Web 3 of yesterday. Hopefully it has more legs. But I think so there will constantly be innovation that private capital is chasing and funding and growing. But also the way we use some of this modern technology within GP firms, within LPs, and the interchange between the two is really starting to affect how GPs have to report to and interact with their LPs. So LPs, historically it was, here's your quarterly statements. It tells you how we did this quarter. You'll get it a month or two after the quarter is over. A couple times a year, maybe we'll give you a schedule of investments to give you an idea of what our portfolio companies look like. But it's based on the information we gather and the data points we care about. That's changing, partially because LPs are pushing for it, partially because the SEC is requiring things in the coming months and years that they didn't before. There's some regulatory clampdown that's requiring it, but it's still a very manual process. As everybody in the room who's invested in private funds knows, it comes in a spreadsheet or a PDF or something like that. If you have dozens or hundreds of line items of private investments, that's an incredibly manual task, trying to dig through that and figure out what risk you're exposed to, what your performance looks like, what your returns look like, what your liquidity could or does look like, and expectations around cash. Technology is really helping in all of those areas. So data extraction tools that are no longer a person or a rules-based engine, but using some of this modern big data and large language model technology is really allowing us to get deeper into those schedules of investment, into some of the operational workflows that come with private markets investment in a way that we didn't see even 12 or 18 months ago.
Excellent. Thank you so much, Ben. So Brian, over to you with the very brass tacks question. So as a public pension fund, how does PE benefit your portfolio?
Yeah, as I said, we're 12.5% in traditional private equity, and then we're another 12.5% in real estate private equity. So we have a 25% allocation to just private equity investments, which is high. I would say that's definitely on the high side for a public plan. You're kind of getting to more of the college endowment space when you're that high. But it's there. If you're structured, you want that illiquidity premium. You've got to have it. Regardless of what interest rates are, you're still getting 200 to 300 basis points on an illiquidity premium. And if you can weather, you don't need that money. Take it. I want that as much as I can get it. And so, yeah. We'll stop there, but no. So the illiquidity premium, and it's I think we all know that private equity as well artificially smooths volatility. I mean, the volatility is there. All studies have shown it, but it's artificially smooth. So it does look good when you can weather those ups and downs and get just statements every quarter. So.
Thank you so much, Brian. Candace, over to you. So you spoke a little bit about the work that you and Sandro are doing as it pertains to the free trade zone. So what are some interesting private equity investments that you've been looking at in Panama and in Latin America, if you could speak to that, given Sandro's focus in that region.
Sure. So obviously the free trade zone has been one of our main investments of the past few years, and like I said, it's going to be the largest free trade zone in Central and Latin America. So we've been kind of very actively looking to develop that project, and right now we've also been looking to seed a manager in Latin America. So we're looking to seed a top-performing private equity manager and a top-performing venture capital manager, probably with a $20 to $50 million check, and then obviously take a percent of their GP. So that's one of the things we've been looking at. So we've been engaging with a number of different managers that we know, that we have relationships with, to see if there's any synergies there. And I mean, they're probably, our top 3 projects right now. And I think as terms of fund managers or companies go, I think if you have a good management team, or a good GP, then things can be, you get interesting. If you're an LP and an interesting manager, you get interesting co-investment opportunities. It just brings a lot. It enriches you and brings a lot of opportunities that you wouldn't have otherwise. So because we're doing both LP positions and co-investments and direct investing, and as you alluded to earlier, a lot of the families are becoming more heavy weighted on directs. So because when we look at it, the personal IRR for our directs is something like, I think, 33%, somewhere between 33 and 35. So the IRR we've gotten on ourselves is actually much higher than what we're getting as an LP. And then there's a control factor, like families like to be in control, billionaires like to be in control, particularly. So there's a control factor whereby you control the exit, you control the timing in ways you can't when you're an LP. So, but we still do both. We still have LP positions and directs, and I think that blend is great.
Excellent. Thank you so much. So the last question goes to Kutral. So how does your firm react when things aren't going according to plan with your portfolio companies?
Wow, that's a loaded last question. See, we are in the venture capital game, right? And it's a very known fact that we are in a high risk, high reward kind of an environment, right? That we jump in with both our eyes open. We know out of 10 investments, I'm talking generally about venture capital. I'm sure everybody in the panel and even most of you down the audience know. 50 to 60% of any kind of venture capital investments, especially in the early stage, when you're operating between late seed through Series B, are we know that, hey, they might not really become your unicorns or superstars, right? So we know that for a fact before we kind of jump in. Having said that, so of course, we would, as venture managers, as general partners, as the people actually making investments, we'll aspire for each one of our investments to really do well, right? Because that's the whole idea. It's not like, hey, it's a very cool idea without doing any diligence, we're going to be putting in money and we're going to speculate. No, this is not crypto, in other words, right? Having said that, if any of our portfolio companies, because they're all in early stages, and most of you, even in the audience, you're all entrepreneurs and established entrepreneurs, the early stage is extremely critical, and a million things can go wrong. Not intentionally, but there may be forces beyond your control, due to which the entire company's future or any kind of cash flows might dry up, and so many things can particularly go wrong, right? So the way we look at it, we kind of segregate it into 2 buckets, and we've been alive for the last 3 years. We launched the fund almost 3 years ago, and we have made close to 9 investments so far, and fortunately 8 out of 9 are doing pretty well. And the one company, so that's where my answer is going to come to, we kind of bucketed to see whether it could have been prevented or is something completely out of our control. Because one of the portfolio companies we invested on, they had pretty high exposure to FTX, right? And we all know what happened to FTX. So nowhere in the world we could have ever envisioned what would have happened, or neither the founders. So that is something where we are helpless, so the founders, but we're trying to see how things can be worked out. So that is one aspect. And there's a completely different aspect where things can be under our control. For example, any kind of strategic decisions, right? Let's say a company has a particular business plan, and again, we're talking about early stage companies, right? And early stage companies might go through several pivots in their business plan, right? Because they want to see what works and what might not work. And a pivot might completely derail the company. So that is where, if we are part of the board and in the capacity of a board advisor or board observers, we have the first-hand information. We can kind of share our kind of inputs from our end. That is one way in which we can kind of advise, or I wouldn't call advice, but at least suggest, make suggestions to the companies. And if things really go south, that is when we as venture capital investors, we should know when to also throw our hands up, which is, I feel, is extremely critical and important. Because there's only so much you can keep putting in capital or putting in kind of like your brain power and work hours behind a company when you know that there might not be any light in sight. That's perfectly fine. But we need to know the particular distinction, and we should kind of like go hands off when we feel the time is right. But if we can help, either through our networks or either through kind of like getting them kind of customer introductions or any kind of, external catalysts, which we as venture capital investors can infuse in the particular early stage company, we go all out for that. So fortunately, Nanban Ventures is in a very good position so far, and I hope that is going to continue. But these are all the kind of different tool sets which we'll have in our particular armory.
Excellent. Thank you so much. Everyone, please join me in thanking this esteemed panel. This is excellent.